To make a move like that, you have to have kahunas and conviction.
Long term, I'm bullish. We could see about a 20% correction next year.
This is Josh Jalinski, the financial quarterback. Don't touch that dial. Okay, everybody, we're starting. Be sure to retweet the space, invite your friends. Chris Vermeulen, did I say your last name right first?
You did, nailed it. Yeah.
Is a financial expert who challenges conventional investing wisdom. Chris, describe your background for those who are just joining us.
So my background is I got into the financial markets when I was 16 years old, got hooked in a finance class. I'm more of an introvert, and I love the idea. Our class made like $180,000 in a semester just picking stocks. So I was like, hey, that's what I want to do. I just have to open a newspaper every morning. So I got hooked into that, but I'm a very logical person. I'm a pilot. I'm like an engineer. I love to build and invent things, systemize things, which is what pilots are all about, is following checklists. I have gone through a bankruptcy growing up. I've been to the bottom, from the top to the bottom and back to the top again. And everything I do now is focused on investing and protecting my capital and growing it. I share it with others, and I do it a different way than a lot of others, where I don't believe really in diversification in terms of your overall portfolio exposure to stocks and bonds. And I only invest and hold assets that are going up, where I sit on the sidelines. So that's it from a really high level there.
How do you know that they're only going up?
Well, I am 100% technical analyst. So, I traded stocks and fundamentals back in the late 90s and did exceptionally well when everything was going up. But even during the tech bubble, when it started to burst, even companies growing quarter after quarter, the share prices still got cut in half. And then they get cut in half again. And I lost my shirt, lost all my money. And that was when I realized, I'm like, okay, fundamentals just fundamentally don't work for investors, because even if they're growing, the company you can still lose all your money and with the share price. So that was when I stumbled into John Murphy, who's like known as the godfather of technical analysis. And it's all about, it's not about trying to predict the future. It's not about trying to pick tops or bottoms and nailing any of that stuff. It's all about riding the coattails of big trends and identifying when a trend is in place. How strong is that trend? Does it meet the criteria to say, okay, this has got some legs behind it. We're going to ride this. And so I look at the stock market kind of like the ocean. When the tide goes up, it lifts all boats. When it goes down, all boats go down. It's the same with the stock market. You don't want to be holding assets if the tide or you're in a bear market. And so that's where I have designed strategies to identify trends that allow us to move in and out of various assets. I use an asset hierarchy. So I have an order that I like to look at things to move our money, depending where the market's moving. But it's all just following price trends. And I'm like a surfer. I am a surfer, but I look at the stock market like I'm a surfer floating out past the break, floating there comfortably in cash, waiting for that next set of waves to roll through. And I find there's about 5 to 12 sets of waves that roll through the markets through various assets every year. And the nice thing is you see them coming, you can identify the strength. And once you hop on those, we also know when a strong trend is starting to weaken. So we start to move out of positions, move up stops, and eventually that trend will reverse and we get the rest of our position out. So I'm just really surfing the waves each year through the markets. And every year is different depending on how volatile it is or how many waves roll through it.
So what are the 5 to 12 sets you see this year?
Well, this year we've seen my core strategy for large investment capital. I focus on the indexes, the U.S. equities markets, focus on treasury bonds, focus on the U.S. dollar index, both the inverse and the long ETF, and BIL, which is like a cash position. So there's lots of other waves through different asset classes, like the gold market and various things like that. But what I'm focusing on large amounts of capital for more so an entire portfolio, I just focus on the equities market. So we've been in and out of the markets a few times this year. The last major kind of buy signal was last November. We had a nice big run up. We got that in the NASDAQ, the SP 500. Right now, we got out of the markets about 2.5 weeks ago. And right now we're sitting in a cash position because the markets, all the internals of the markets started to give us a bunch of haywire, bunch of noise. And our strategy says, hey, when the trend is totally gone and it becomes like white water, we just want to move aside and let the markets shake themselves out. And that's what we've been seeing. So this year has been an equities market. We've been in equities, and right now we're in cash temporarily until we decide Is this market going lower? Do we move into the US dollar index? Are we going to move into bonds, which bonds are just starting to form a bottom and a new uptrend that hasn't quite confirmed yet. But TLT, for example, the long-term treasury bonds might become a very good play second half or the rest of this year and into next year.
Why would you buy TLT? Why wouldn't you just buy 10-year treasuries?
I mean,
just for the ease to get in and out?
Yeah, it's easy. I mean, we move a lot of money. We've got a lot of investors who follow our strategy. We use an automated trading strategy for investors who can just have them executed for them. So there's the liquidity there. Everyone knows it. People like to do what they're comfortable with. That's just the vehicle that I've always used. So that's why I stick with TLT.
Yeah, I just saw that it blew up in 2022. So I kind of, and we technically traded it, and it was disappointing. I just rather do what Lacey Hunt does, and he buys the 30s and the 10s, and you trade the 10s out against the 2s. And I don't know.
Right.
For me, I mean, it occasionally is clunky. So it's easier to trade TLT.
Yeah.
Like if you're making an order, like, we had an order in, we bought a bunch of 2s Wednesday or Thursday, like perfect timing before it dropped. Not that intentionally, but
Yeah. It just
we
worked out
saw
really
the trend, but not, But yeah, TLT just did things in 2022 that it didn't do before. Technically, it was very easy to trade TLT for a while. Technically, that's the other thing. I mean, I'm big in the TA. I find that most of you TA people, and I'm going to give you a pushback.
Sure, go
and maybe
for
we'll
it.
do that a little bit, but maybe you'll want to hear it later. Most TA people are kind of BS artists, and don't take that the wrong way. But I mean, I'm friends with some of the best technical traders in the world, and like you find them, and they're like some of the best guys who we've heard of. CMTs. They have millions of subscribers. Like they're not wealthy themselves. They're just really smart analysts. So they know how to tell you to do what to do, but they don't do it themselves. Yeah. And then we subscribe to other people besides doing our own TA just to see, what Tom McClellan says. I like his work. I like Stan Harley.
It's an interesting read. There's something about his writing. It's like intriguing.
Yeah, I don't. You know what? Tom McClellan.
It sucks you in though. I don't like it because it can shift your mentality. So just a long story short, I'm very different than most technical analysts. So I have been doing a financial newsletter online, doing TA since 2001. I have seen a million newsletters come and go. You can paint a chart to look amazing and get people's attention and make it all artsy and suck people in, right? What I do is very, very dumbed down, very simple. I track money flows between risk on assets, risk off assets, cycle analysis. I put a lot of stuff together, but I don't do flashy stuff. I don't suck people in with all kinds of chart patterns and stuff. I just say, here are the trends, here's the bias. This is where the money is flowing and how strong it is. But I totally get it. There are a billion TA guys out there and they all show fancy charts. And I used to do this like a decade ago. I would write articles and do these fancy, colorful charts and paint a really good picture and it gets people all excited. But I mean, that's not, that was a long time ago. That's the space because it works for marketing, right? That's why so many people do it. And now I only focus more so on high net worth individuals. The strategy is for my money and I just share it with other people. So I like fly under the radar. People who know me, who follow me, they're like, I was told I was the David Attenborough of the stock market when I do my morning reports. I'm like calm, cool, collected. And I don't like to stand out. Right. So I just want to help people and I do my own thing, but I totally get what you're saying.
Yeah, and we're going to talk about TA people, TA BS artists in a little bit. But I've been guys, and I'm not going to share with you the guys that I don't. Like, there's one guy who is world famous. Wonderful guest, by the way. Gentleman,
Probably.
Scholar, nice guy. And if I even say what he's famous for, it would give him away. So I don't want to. When I do a YouTube with him, he had like 2 million followers or whatever. And like his people chided me that I didn't give him the respect he deserved. Although I did, I really respected him. But his
picking
work,
away at people is good. I mean, that's part of it. That's good. That's a good interview, is asking good questions and why. And
I fundamentally believe he went to a talk by somebody like McClellan or Harley and people that I've known that do really hard TA work. And he took, this cycle, and he then made a living out of this one cycle. And if you study cycles, there's the 4-year cycle, there's the 53 cycle, there's the 89 cycle, there's the 7-year cycle, there's the 89-year cycle that turns into 93 years, it turns into 84 years, and I mean, I'm a big cycles guy. Like, I do believe in it, but a lot of it changes like daily,
all the time.
Like Stan Harley is like the guy. He kind of sucks me in sometimes because he's so certain, but he's always revised. He generally, I think his fundamental, I'm sure other people have done it, but his work, McClellan is good for charts and graphs and kind of linking today with the TA framework. Although the problem with reading McClellan is he's so good, you think he's right. So it can make me a bad trader. I know exactly what you mean. And Harley's the same way. But the reason why I read those two and very few other TA guys, and maybe you'll be my third guy I read, is they project certainty and don't tell the audience when they're wrong. Or they don't make a very direct call so that then they can be called. Like, one of the reasons I love Stan Harley is he will say, okay, 4 weeks ago, I was bullish. And now he's bullish again. And then 4 weeks from now, he'll go bearish and he'll go like, what happened? But he will explain like why he's now bearish, what happened, the thing that he was, the 53 trading day cycle low that happened. He thinks Monday was the trading cycle low. But it is funny because most people think it's BS when they listen to it, because if somebody's really putting their charts out there like Stan does, you'll see like you did have a 34 trading day cycle. Now it's a 29. Now, if you know people deep enough, they'll share with you their, it's like an accordion, expands and contracts. Yeah. But it's like the weatherman. They're never really wrong. It's the pattern. So how do you really trade in a determinative, like in a functional way, when the cycles always change, when the cycles are never wrong? Like, I fundamentally believe in cycles, right? But here's what I mean.
Yeah.
And I've been reading Harley, so I'll use him as an example. Harley says the peak of this cycle is about November 8th, and then he's worried after that. But then he says, Monday was the trough. October will be another trough. There'll be a peak somewhere in the middle. Things could get worse. Then things will rebound by early November. Then he's more worried about that crash than this crash.
Right.
That makes sense to me because I've been studying TA for years. McClellan says the peak he's worried about more is the August peak, which really didn't happen yet. So maybe it's going to happen in late August. One of them's usually right. But, it's funny. I've studied both of them.
Yeah.
And then there's another guy who's pretty good that I've read occasionally, but I don't, he trades options. So his cycle work is really very narrow. And that may be what yours is, where you can get some success. Like he'll trade in and out of SMH so how do you like really functionally, I believe in TA. I don't believe it's just fortune cookie reading.
Yeah.
But how do you really trade on it? Like, I know this is what you do for a living.
Yeah.
But it's what I do for a living too. But I find that TA is good sometimes and sometimes it's not. It's like,
yeah, totally. No, it's a great question. I mean, what you're explaining is everybody trying to pick a top or pick a bottom, and then it sounds like they're like betting on that forecast, right? Which that's not what I do. I let the markets do what they do. I don't really care which direction they go. I have been bearish on the markets for like 2 years, and I talk about it. I think the markets are topping. Things keep getting closer and closer, but we're still long the markets because I follow the trends. And I think where I separate a little bit from that, because I do have a cycle low. Monday was a cycle low on one of my strategies. Not that I don't trade cycles. I just use it for input, for analysis, but it's not part of our actual. It won't force us into a trade. It won't make us skip a trade. It's more so just, do we have a tailwind or are we running into the wind here, right? It's more so just to know that side of things when it comes to like time cycles like that, like the 28 or whatever cycle you're talking about. But what I do is I focus on the money flows from, is money moving into utilities? Is it moving into gold? Are we seeing money flowing into different currencies?
So it's a different model. Your model is not really a cycles model. It's more of a money flow model. Like, where's the big money moving? And you want to be on
right.
that,
And when you know where the money is moving, you know their mentality, and you also know what they're doing with their cards or what their money. And when you can identify if money's flowing into risk on or risk off, like if you go to my YouTube channel, like the last 3 videos, the title is to kind of step us through the markets. I'm like, this divergence like always signals a very sharp crash. And I talk about just a couple of days ago on Friday or Thursday, I said the divergence between the utilities ETF XLU and the SPY. Every time we see this, the market has a very sharp crash. And then of course we see the crash. And I just kind of I just walk through the markets. Like every day I do an update, not always on YouTube. It's for my subscribers, but we walk through the markets every day and we just analyze. But it's not about saying, I think it's going to drop, let's buy an inverse ETF. It's, we wait for the price to actually change direction. So when there's a market rally, we don't get in at the bottom. I mean, the market could rally 5, 6, 8% before the trend from my side says, okay, we're in a strong uptrend. There's big money flows. There's a lot of movement behind it. Now we can get into it. And then we ride that trend. And then eventually the market will top and it'll drop down 4, 5, 6%. And then we get out when that trend is like now broken down, when money flow is flowing back into defensive plays and the price action has pulled back a certain amount, then we'll just get out of it. So it's not about trying to pick the tops or bottoms and then bet on that forecast. It's about, I do like to forecast and be like, I think this is what's going to happen, but we wait for price to actually confirm and prove and say, hey, this is a strong trend. It's worth getting into. And then we get in and we trade it. So it really is just riding the coattails. I don't actually predict or have to do any of that. It's like, here's a new trend. Does it meet our criteria? If not,
so it's more of like a high probability trade. What trades worked against you this year?
Against us, well, we've been long. We haven't had any losing positions yet because we've been long the indexes. So we've had a couple of trades where we get into the SP 500 and the NASDAQ. We hit some targets. The market starts to pull back a little bit. We close it out. And then it regenerated a new signal and started to go higher. So we've just been in and out of the SP 500 and the QQQ, NBIL a couple of times. So when we exit an index trade, if bonds don't meet our criteria, which they haven't since the very peak in 2020, and if the US dollar index ETF doesn't meet our criteria, then we move to bill. So we've been either in the stock market riding it up or sitting in bill, collecting daily, monthly interest, and then back into the stock market. And right now we're back into bill, waiting to see if this pullback is just a pullback or if it's a crack to the downside and, the charts start to form more of a bearish pattern and break down.
I still think some of this is BS, so don't take me the wrong way. I really value TA. Like I use it every day. But I look at it as like a probability and statistics. You're probably right. Here's the other question I have.
So, but what's the difference between doing something that gives you a better probability or just playing off a guess or the news and economic data, right?
Oh, yeah,
I'd rather go with statistics and probability than.
But here's where I worry, right? Okay. This recent crash, whatever it is, it fits beautifully into the 53 trading cycle low. I mean, like perfectly. So do you trade that? Do you buy SPY? Do you buy NVIDIA? Do you buy QQQ? We're not giving you any buy or sell recommendations, people. But my point is like it looks like a really juicy tradable low. But then I also could see if we get a little push to the downside, if we touch the 200-day moving average, like all the CTAs and the computers are going to sell, and then we have a 30% loss before we knew it. You know what I mean? So it's tough to, to me, it it's a beautiful chart. I got a great chart. My buddy sent to me. Looks like very bullish. Ride it up for a couple weeks. Get out September 1 or Labor Day for the next leg down. Then kind of ride it back up in October. Like it looks like a really...
It sounds pretty good. It sounds about in line with what I think could happen. Yeah.
It looks like a nice formation. But then you have this other layer. By the way, this happened March of 2020. Fake people out. Because it looked like a nice tradable low. Late February, early March of 2020. Then the bottom fell out. And it was a scary 2 weeks, 3 weeks. And then a lot of people... So the last time I've seen something kind of line up like this was, there might have been some other times, but it just looks to me like too good. And then all of a sudden, boom, something happens. Because now we're dealing with computers, right? And all these algorithmic traders. And they sometimes throw off these things. And the cycles will often tell you the change in trend or direction, but it doesn't tell you the magnitude. Yeah. Well, magnitude's a big deal because I could afford a 10 or 20% downturn. Can't afford a 40, you know?
Yeah. Well, I mean, you get cycle skew, right? So I talk about this in my book called Technical Trading Mastery, which is you can layer in there's multiple different cycles at play. There could be like a 4-day and an 8-day or who knows, a 34-day, 93-day. Like there's all kinds of great cycles. And if you lay them all together, you can have like a cycle analyzer. And if a whole bunch of them are moving up at the same time, you can get a very strong move up. Cycles are extremely difficult to trade because of cycle skew, and there's underlying longer and shorter term cycles that throw it out of whack. Everybody has a different way of trading cycles. And the problem with cycles is when a cycle, like right now, if somebody was looking at the SP 500 chart or the NASDAQ, doesn't matter. The pullback we have right now is the same cycle low and setup with multiple cycles as we saw right back in April of this year. It's also the same cycle setup we had back in October of last year. Yeah. And it's very similar to late January of 2022. And what happened right now, when I look at the long term, like the bigger cycles and the bigger money flows on like the weekly charts, we actually have a setup very similar to the January 2022, which was the start of a pretty rough year for most people. It was a bear market kind of phase. So, we do have a cycle low, but the problem with cycles is when that cycle actually breaks, you get like a double move to the downside. So we've had the cycle low now, but if it breaks, we're going to see another precipitous drop, and it hurts. Yeah,
you don't want to be in that drop. That's what I'm saying. Like you go April, exactly right. October, you can even probably go before then as well. But the setup is exactly, I was going to bring that up, exactly like January 22. And a lot of fools rushed in. Yep. And that faked a lot of people out. The October, to me, this is a way more difficult market to trade. I don't know, just me and how I traded it. October and April of this year were easy. Yeah. January 22 was hard. People will say it was easy, but it wasn't. And I think this market we're in is a very difficult market because if it breaches. So for me, what I'm doing, and I want to know what you're doing, I'm looking at price levels. Like I'm looking at, okay, are we going to break 5106 or something like that on the S&P? If we break that, I'll start to get really bearish. But if we hold at 5300, 5250, I'll be bullish. Do you do that too, or not really?
No, not really. So I need a lot of different things to line up in order to.
No, I'm like that too. I look at a lot of stuff, but what do you look? If there's one thing you could give us to say, this would mean that it's more like January 22 than October of 23. What is that one? I know you look at more, or give us a couple of data points to look at then.
Yeah, there's a lot of things going on right now that's similar to 2022. We have gold's doing exceptionally well. Utilities are screaming higher, a huge divergence, like a 12% spread over the last few days between XLU rallying 6%, the stock market more or less falling 6%. We saw that just in February just of 2020, just before the market crashed. We also have this huge flow right now. We had a big pop as we saw everybody moved out of the Magnificent Seven, and it was massive selling in the SP 500 and NASDAQ because of it. But the Russell 2000 shot through the roof. It took off. And we actually, this is people saying, hey, well, I'm nervous. Generally, people in the Magnificent Seven, because they're headline news, they're emotional traders. They all pile in. They quickly are the first ones to spook out. And then they're like, where the hell do I go now? So they all move to small caps because they're like, well, these are other type of growth stocks. And we saw this exact pop in the Russell 2000 back just before the stock market topped in 2022. The Russell 2000 popped for like a week and a half, just like we saw. It was another type of shift. We actually saw the Russell 2000 do very well in early 2008, just before the massive leg down. So there's a whole bunch of things lining up of the just the mentality and the money flows behind the scenes, lining up saying, okay, we're going into a bearish phase like 2022, or it could be a hell of a lot worse. And we could see a much go into like a stage 4 decline, which is like a full on bear market where we see like 30, 40, 50% decline. So the big picture analysis, and we look at unemployment starting to rise. Industrial stocks have been screaming higher. Typically, they do well right as the major stock indexes are topping. Energy stocks have been trading up near all-time highs. When you zoom way out, they're way up there. So those three things together alone are a warning sign that we're generally in the late stages of a major top in the equities market. And now we're starting to see economic stuff coming through, and the economic data and cycle tops out after the stock market. So Canada's in a recession. Overseas, there's a bunch of recessions, different countries. The United States isn't officially in one, I don't think yet, although, I mean, if you follow the trends, you can see it and smell it and taste it already. So I think we're going to see things soften up. So that's why I think it's more like a 2022 or a 2008 kind of market top brewing here. And but it's not I don't look at price levels. So our strategy uses a bunch of different analysis and says, hey, the trend has stalled. The money flows are now mixed, and it says move to cash or move to a different asset. And typically, if we're not in equities, we go to TLT. If TLT is not favorable, which it hasn't been, then we move to the dollar. And the dollar has been flatlining and chopping sideways for the last year and a half. So it's not favorable right now.
And when you buy dollars, you buy BIL, the ETF.
When we buy the US dollar index, we buy UUP, which is the dollar index ETF. So for example, UUP, the dollar index, is what we bought and held several times through 2022. The US dollar rallied 18% while the stock market fell like 25%. And the biggest pullback in UUP during that entire year-long rally was less than 4%. So that's what I love about currencies. When the market goes haywire, we move down our hierarchy of assets. And as the market gets wilder, we're moving to slower and slower assets. So to be able to move into a currency that trends really nicely, that has very low volatility, you're not sweating bullets waking up in the morning going, oh my gosh, a 5% gap down. Like that's what the equities markets can do, right? But currencies are very, very slow, and they are not connected to the stock market the same. They can go their own direction. So we just, right now it says be in cash because nothing is setting up to tell us to get in yet. So I don't know where we're getting in. If the market recovers and starts to muscle back up to probably 5,600 on the SP 500, we might get another buy signal depending on how strong the power is behind that. What kind of money's flowing in? Where's the money coming from and moving into the stock market? So there's a lot of little moving parts that tell us, what to do. And I just sit back and I let the system, the strategy kind of update, and we just move and analyze and trade it from there.
What do you, what role do you give computers in all this? Since your company is called The Technical Trader.
Yeah. So I have my strategy that's programmed into, I use a platform called eSignal. And more or less it does all the different layers of analysis, color codes the chart, tells us where there's a signal. And then it breaks up each piece so I can see visually, okay, all these things are lining up. I can visually inspect everything. And then we have the system that runs it just straight on the screen with green bars or red bars and purple for a new entry and yellow for an exit. Our whole strategy is based around end of day data. I don't use any intraday data. So we'll get a signal after the market closes, after all the exchange data has updated for the final closing prices. And then if we have a trigger, we send out an update, or the next day at the opening bell, we'll say, okay, exit SPY, 100% of our position, move to cash, and then, invest, move it all into BIL or whatever it is. So it's a strategy that's fairly passive. Again, we only have 5 to 12 position changes a year, which is a lot for a passive investor who doesn't do anything, but very slow if you're an active trader. It's it's kind of in that sweet spot. As you know, when there's an awkward time or sweet spot, it can do very well. And the market has some beautiful waves in this kind of time zone, but it's too slow to keep people's attention. And so that's what I have to do, is like let people keep knowing what's going on, what's unfolding, because these moves are like, the last trade lasts several months and people are like, this is kind of boring. We haven't really had to do anything. I'm like, this is amazing. Boring means money. I'm like, that's what we want. But people like action, which is, I find painful. They think they need to trade all the time. They need to be in volatile stuff. I'm like, it's just dangerous. Like, don't mess with volatility.
You wrote a book called Asset Revesting. Explain what asset revesting is.
Yeah, so asset revesting. So I kind of looking at it like a new category, a different category of investing. So you've got the buy and hold diversified portfolio. You are guaranteed to have average returns. It takes you 40 years to build massive wealth. You're going to go through some crazy wild roller coasters. And then you got the other extreme, which are active traders. And I've been in that space for many years. That's where I kind of got started, because I've day traded, I've traded Forex and currencies and options. I've gone through it all, and I found my sweet spot to be ETFs. But active trading is very dangerous. There's all kinds of statistics to say anybody who actively trades for 300 days or more generally never makes money, or they lose money. So the buy and hold is painfully slow to get wealthy, and it's a roller coaster ride. Active trading is a great way to blow your accounts up, pull your hair out, all kinds of stuff that goes with it, break you mentally. And then asset revesting is that sweet spot where I'm just looking for the tide to be rising and swells to be coming through the stock market every year. And we can see them coming. It's not like a trade pops out of nowhere. We can see it usually a week or two out. We're like, here comes a wave. It's starting to meet our criteria. Things unfold. And then boom, we hop on the wave of whatever it is, the indexes or bonds, whatever. And then, of course, as they start to weaken, that's the nice thing about a strong trend, is you can tell when it's weakening, and we can just carve off that wave, trim our positions, and then it rolls over and we're out. And then we wait for that next wave. So it's about just identifying strong waves in the market, not trying to trade the noise and the Fed and all the chop that comes on a weekly basis. And it's really about just moving our capital to whatever asset class meets our criteria for risk and volatility. And we hold it. And as soon as it doesn't qualify anymore, or we hit all of our targets, we back out into a cash position or a different asset class. And so, a lot of people say, oh, I have a ton of ETFs. I own a bunch of stocks. I'm diversified. To me, it doesn't matter if you owned all that stuff. To me, you just have one position. You have stocks. Stocks is one asset class. I don't care how many sectors or different stocks you own. When the tide goes down, those boats are going down with it on average. So that's the way I see it, is if something's going down.
So you're really an SPY or some version of that IVV. You're not really in any other equities class.
Don't do anything other than the SP 500 index, NASDAQ index, bonds, dollar, and bill. That's it. Just those like 5 ETFs. That's where we focus.
What about gold?
I do gold, but that's not part of this strategy. Like, I own gold. I buy physical gold. I love physical gold.
Why wouldn't you have GLD in there or something like that? It just seems like you would be a guy who would have that.
I know.
Extra.
I have a gold trading service, like, because that's I used to be the gold and oil guy. That's what everybody knows me for. I'm big into physical, but the thing is, the precious metal space goes in and out of favor.
I got you. So it's not a good business model for you. As much.
Yeah, but it's not a good investment either. Like, if you've got miners, you're still down 50% from the highs.
No, but what about gold? What about GLD? I mean, do you like gold right now? Technically,
I do. I like, check this. Well, I don't know if anybody can actually see this, but like, here's a 1,000-ounce bar of silver. Like, I love precious metals. I accumulate them. I think they're brilliant, and I'd rather just I like physical metals right now, but I believe the stock market is going to go into a huge reset over the next 12 months. I think gold and everything will get pulled down temporarily. Gold miners are going to get absolutely slaughtered again. And then it's going to be the next super cycle for precious metals. It'll be like the early 2009. You get into precious metal miners or gold, and they rocket higher. So I'll be focusing on those for a portion of my capital. But when it comes to like managing a fixed kind of portfolio and managing risk, gold and precious metals, they become a speculative type of play during the perfect storm. But we're not in the perfect storm for them right now. I want to move into them when I think we're going to see hundreds or thousands of percent moves in the miners, and also see gold, shoot up to 3,000, 5,000, and silver to 50 or 80. It's just a different pocket of money that I manage.
But if we go through a bear market, couldn't you see gold get cut in half in the stock
market? I don't know if it would get. I can see the stock market get cut in half. I mean,
long term, I see gold being 3,000 too. It just when is that? Next year, 2 years?
Yeah, it's a year or two out for sure.
I'm very bullish on gold over the next 10 years because I actually think we're going to have more persistent inflation than the Fed thinks.
Yeah.
I mean, if I'm to play out, I don't know, I would like your take, but I could see them cut rates and then a year from now, 6 months from now, say, we still got inflation. We got to raise it again. And then we have this perfect storm where we have this 08 style crash because everybody thinks we have relief this year or the next 3 months. And then sometime around 2025, we have this massive bear market where just everything starts to go down. Gold, equities, real estate.
I think gold could easily pull back to 2,000 or even 1,800. Yeah. So I do think it actually is still going to run to about 2,650, 2,750. That's what the charts are pointing to right now. So there's still 10% upside in gold. But I do think once that correction hits, almost everything gets sucked down with forced liquidation, margin calls.
My short-term price target for gold is about 2,750 too.
Yeah.
And then for whatever bear market happens next year, I'll bet
it's going to take
1,850. It'll probably be a better way to weather. I just think, every data point, this is crazy. We all want it to be a bull market continued. But you look at every data point, Starbucks, McDonald's, just yesterday, Airbnb, Supermicro, they're all signaling, get out. Other than the market's very there is no real recession. It's like we're talking ourselves into this recession. Like things are still fundamentally good. Jobs aren't being cut. Wages are strong. Other than
everything's weakening. The thing is, we have so much data, we can see trends starting to weaken, and people think just because they're weakening, they think the end is here. But just because we can see it, it still takes time for things to bleed over, for business to be rough enough for enough quarters where the owners are saying, we got to cut some employees here. We got to start trimming, some of the fat off. So it's going to be a slow process. But once it starts, it picks up speed.
But what if it's accelerating now? Meaning, what if the problem is this isn't like 08? Because although people knew about knowledge in 08, you really learned about the crash from CNBC. I was in the industry. We'd watch CNBC. I don't even know if Fox Business was really around then, but it was CNBC. That's all you, and some outlets here and there, some newsletters, what was it? It was like CNBC and Stansberry, and all these new. So the 06 to 08, before the crash period, I saw the handwriting on the walls like a 22-year-old. And I see it now, but the one thing I fear about is data moves so quickly, and March of 2020 kind of proved this, that we had the equivalent of the 08 crash begin and end within 60 days because everybody has so much access to all the data on social media and YouTube. So if you're trying to avoid the markets, like I don't watch TV anymore, pretty much.
Yeah.
I still see your face on YouTube or, meet Kevin or Steve Van Meter. And you see all these bearish people now. And so then even if you don't really pay attention to the news, it's in your face on whatever.
Yeah.
If you don't watch Fox News, it's on MSNBC. If you don't watch both, it's on Instagram now. It's on YouTube. It's on TikTok. And it finds you because the algorithms. So the only thing I worry about this bear market, I agree we're sort of headed to one, but is it going to be, because everybody's thinking it's going to be next year? Is it going to be next month.
Mm-hmm.
And really, the cycle low that says October is really a 30% drop from now, just because
It could be
everybody
fast.
gets like it just moves so quick. How do you know with what you do when it's this quick mega bear?
Well, the reality is we don't. Nobody does. And that's why I don't try to pick any of this stuff, right? So, I think the COVID crash, just like price action, when you see a piece of data come out on an individual stock or something, or even the Fed comes out with a piece of data, price spikes or it drops. And then it usually reverts to the mean shortly after. COVID to me it was not a bear market. It was an event. It was a piece of news, a piece of data. It just shocked the world. Everybody just dumped shares and panicked, and then it kind of recalibrated and then started taking off with all kinds of Fed, helping support the world or the markets. So I agree. I remember watching the May 2010, I think it was a flash crash. I remember we were sitting in my trading room. I was out washing my car. It was a hot summer day. And all I hear is him screaming, going, get in here, get in here. I walk in. I loved volatility. Back then I was trading futures. We traded it and made a bunch of money in like minutes. It was unbelievable. Total crapshoot though. But again, it was just a quick event. It reset. So I do think this market will get into a precipitous fall. The question is is it going to be a 30% drop in a month or two? I for some reason, I feel as though it's going to be more like a 2000 tech bubble. I feel as though the US dollar, the US dollar index is going to rally very strong. I think we're going to see technology unwind and people start to move out of the space and people get spooked out of it. I have a feeling this thing could drag out for several years and it might actually be a bit slower bleed. Usually the market does what everybody least expects. And everybody's worried about a crash and everything being so imminent. But it's funny how things unfold. And people will probably be like, we look back 2 years from now and be like, wow, look at this. It's just like these, slow bounces to the downside. So, I mean, we don't know what's going to happen. The key is having stops in place, having strategies in place. So if the markets are going down, you're not in them or you're benefiting from the longer term falling trend. The reality is none of us know. And that's why it comes all down to risk and position management, which is why I kind of stick with simple ETFs, things I understand. There's cycles and money flows and data points that come into the stock market every week, every month, every year. It creates these beautiful data points and movements on the charts. So I kind of focus on what I know and what I understand.
And what do you like now? Just cash?
That's it. I like cash and I like gold. Yeah,
do you like utilities or no?
No.
When would you buy utilities and when would you buy TLT? You mentioned TLT.
We actually held utilities in one of our other strategies. So we do have a strategy where we trade sectors, whatever the leading sectors are. We were in utilities. We sold out of them a couple of weeks ago, a week or two ago. But it's right now. It's enjoy summer. Summer's here. My kids are not in school. We're on the water having fun and we're in cash. I mean, honestly, it couldn't be a better situation. So that's just, I just go with it. Whatever the market throws. See, this is the one thing I have definitely noticed. I'm an entrepreneur. I have different businesses. I love to invent stuff. And I saw another guy, he was on YouTube. It was an older gentleman. And I don't know who he was, but you can tell he's traded his whole life. He's sharing his life insights on traders and investors. And he's like, one of the things he's noticed, and now I totally see it, is the stock market brings in some of the sharpest, most sophisticated individuals, professionals, and we all come into it, and entrepreneurs come into it going, okay, we can totally do this. If other people can do it, we can definitely do it. And he's like, entrepreneurs come in and then they absolutely lose their shirt. And they're like, why can't I make money trading and investing? Why am I just constantly on the wrong side? And I think a big chunk of it is because we move into the markets, entrepreneurs make things happen. You create your success. In the stock market, you cannot create success. You have to let the positions, the markets come to you. You have to identify them and you have to wait. And that's the most painful thing, is waiting for another trade. Right now we're in cash. It's the most boring thing we could do, although it feels great when the markets are in total chaos. But we have to let the trades set up and then move into them. And it's like you're always just waiting and waiting, and then you're into them. So it's very different than, day traders get that satisfaction. They're like hunting every day and they find trades. Even if there isn't a good trade, their brain will find one. Whereas I'm different. We sit back and a lot of things have to align to be like, okay, here comes 3 massive waves. Which one fits our criteria? Which one are we hopping on? Which one has the best risk profile?
So you're fundamentally bearish. When you go bullish, Like when does the theory of the 53 trading cycle? My friend is a big cycles guy. I would argue he's the most knowledgeable one and the humble one on the days.
Okay.
He says, the 34, the 39, the 28, what is really the same cycle.
Yeah, I would agree.
But you have to do the work to figure out whether it's 25 or 40 or 38 or 30.
Right.
And that is hard work. And so he's literally like every day, plotting,
I say you need to have a few shorter term cycles in there too, to help you identify like, oh, a couple of these other shorter cycles are lining up at the same time. It's day 28. This is probably the low, right? So you can use some other cycles to help. But
which one do you like? What, the short one, the 9, the 3, the which one?
The 3 is pretty good. The 9, I love a 20-day cycle. I love the 20-day moving average, and I love the 5-day moving average. I find those two the most simple strategy.
It's funny. I like the 9-day moving average. That's funny.
So it's right in between the 5 and the 20 that I like. So it depends on how you look at it and how you trade around the 9-day. We might actually be trading something very similar when we look at it, but my general theory is if the 20-day moving average is sloping up, price is above it, you're naturally and the 5-day moving average is above the 20-day. That tells us we're in an uptrend. When the 5-day moving average closes below the 20-day, you really don't want to be in the market. We're on a swing kind of low. But I love how the SP 500 runs up the 5-day when you're in a strong trend, and it'll naturally correct down to the 20-day, and then it'll regain and get back above the 5-day.
That's similar to how I use the 9. Yeah.
So the 9 is a hybrid right in the middle, somewhere in there. So yeah, it's
similar, and
there's certain patterns in the stock market that everybody has their own way of trading it, but we're all kind of playing the same movements. We just see it differently, right?
And that's what worries me too. Since the advent of technology, I saw Monday. Is Monday the gap down of the bear market, or is Monday just the computers just sold a crap ton because the Friday closed below a certain amount? You know what I mean?
Right. Yeah. I don't look into it too far. I just find over time price action has a way of just being accurate. You just follow the price, and you don't know when news is going to hit. You don't know when a huge gap is going to hit. The key is just understanding the short-term momentum, the longer-term trends, where we are in those movements.
What are you seeing right now?
Right now, I see, similar to what you mentioned earlier, I think this market could bounce for a couple of weeks, form a little bit of a bearish pattern. If it starts to roll over, it's going to have another leg down. So I'm more bearish. I think it looks just like the January 2022. I think we have a lot of underlying technicals momentum stalling out. So I do think we're going to go into something a little bit bigger. I think we're going to get a bit of a bounce, but I don't think it's like anything to get excited and expect like a 2-month rally or new highs. I think it's more so if you catch some of the bounce, you're lucky, but be careful.
Yeah, I'm thinking it's like a 3-week bounce.
Yeah.
If we're lucky. And that's if we're lucky. You might have.
I agree.
Just this overabundance of panic. That's the thing. Say the people that are still in the market right now. When would you like? I mean, I know you're in cash right now, but when would you be like? Now we're in something of a different magnitude. Because the best time to trade was 2-3 weeks ago, but now it's like a little too late.
Yeah, like if we look at the SP 500, I think if we can get back up to like 5,400 or so, or 5,450 somewhere in there, I'd be like, that's a nice bounce. I'd be happy just to get out. I don't care where you bought. I don't care if you bought the high of 3 weeks ago, but I'd be like, if we get a bounce, I would get out of this market, because you can always buy back in later and ride it higher if the trend starts. But if this baby rolls over, I mean, we're going down for another swan dive. So, I mean, right now we're still like the long-term investing signal is still long. We're still in an overall bullish market. It's just the shorter term analysis. We don't want to catch a downdraft here. We want to stand to the sidelines. And I would think, if we start to break the lows that we saw on Monday around that 5,120 mark, somewhere in there, depending the money flows and depending the level of fear and all that stuff, it could be a high momentum move. We could see the markets drop to 4,900 fairly quickly. But the faster something drops, usually the quicker it's going to have a rebound and shake things up. So it's really hard to say. This is the whole reason why why we're in cash is because there isn't a clear direction. This thing could just drop from here, and the VIX goes back up and all that stuff. So it's really tough. This is like when we get this type of volatility, Josh, it lures people, it sucks people in. I think volatility, for some reason, people now are buying triple inverse ETFs. They're buying put options like they're going out of style. They're all betting on the downside. They all just sold out of their positions, their long positions. Now they're betting on the downside. Volatility is like one of those purpley blue bug zapper lights. For some reason, it just draws the traders and investors out there like huge moves. Look how much I could catch if I had a 3 leveraged ETF. Could have been a 15% move in one day. Or look at the options move, like hundreds of percent. Like volatility, this sucks people in. And it's actually, this is when, we step back. So the key here is there is no clear direction. We need to figure out what this is, a low or a pause before going lower. I don't know. And that, everybody wants an answer, but there is no answer. That's why we're on the sidelines.
Exactly. What's interesting, the level of, and people always say, well, but the economy is so bad. Why is it going to rally? Or, the short squeezes and like you said, the inverse, people forget, the VIX shot up to like
176% in pre-market the other day.
We have not seen that level since COVID.
Yeah.
And we're nowhere near the magnitude of the potential decline of that. Maybe that might be some long 18-month bear market,
Yeah.
But this is that's unprecedented. I actually think a lot of the move and the spike in the VIX was due to you see these, I don't know how much. Do you know how much people are trading VIX ETFs and triple? Like, do you get data flow on that? Like,
I used to watch it, and then when one of those VIX ETFs blew up, remember years ago? Well, I held some of that, and I lost 98% of my position like overnight, and I've never traded one since. I'm like, it's total BS. I wanted to trade the other ETF and just short it, but when there's a very high probability of making money, they restrict the shares. You can't short the damn thing. Like the financial markets are great at trying to screw everybody. So I just know there is a ton of people who trade VIX options and VIX ETFs, and they go nuts because they like playing with fire. I mean, that's what they are. They're literally grenades, and they blow up. You either catch it or you get blown up. You bleed out slowly.
It's amazing though. The one VIX ETF has been around forever.
Yeah, there's so many now. I don't know. I just don't touch them anymore.
I don't know what the volume is. I'd be curious.
Which ETF are you thinking of?
I'm thinking UVXY because it has a lot of trading. I'd be curious, what was the trading volume last week compared to Thursday, Friday, Monday? Because my thesis on why Monday was so bad was that the internet was pushing this narrative. People then crowded into this trade. It popped. And then it's going to drop just as quickly, but I don't know.
So that ETF was trading, like if you go back before the volatility started, I mean, it was trading, 7 million shares or less on average. Yeah. And then of course, the day that it dropped, it traded 40 million. So a huge difference.
I mean, that's a huge.
Yeah.
And then that's spiking the VIX. What's interesting, why is it going up today? What's the spike in volatility today about? Because nothing's changed.
Yeah. I mean, let me just get to the daily chart here. So yeah, the VIX, I just think there's fear carrying over. I mean, the markets are selling off today. Like they were up, the NASDAQ was up 2% this morning as you and I were talking. And now it's, what is it down? It's down
0.43.
It's down half a percent or so.
They're listening to you.
So there's a big selling going on. It is high volume. There's lots of red bars on the volume side. So there is some selling going on. So people are getting nervous. The selling is picking up speed, and the VIX doesn't need to go actually much higher. This stock market could actually still drop another 4 or 5%, and the VIX will not go up significantly. I think a lot of the fear just got shaken out of the market. We see this all the time. The market sells off like on Monday. We see the VIX skyrocket, and then the stock market continues to grind lower over the next 3 or 4 or 5 days and make lower lows, but the VIX doesn't. And that's usually actually a really good contrarian indicator saying, okay, the stock market is actually getting closer to a bottom. And
that's what I'm seeing. I mean, I could be wrong, but I mean, I could see another 4 to 5% down move, but to me, like that's just a normal.
Yeah, it's totally
like
normal.
What we
But
saw
people
in
are going to
April
freak
or
out.
October. Yeah,
Yeah.
I think there's a freak out. I think people still. I do not underestimate the power of the collective freak out every so often. You know, like you said, you're on vacation. Traders are selling in August. Hey, I'm going to go on vacation. I'm going to move my position to cash. Come back in 3 weeks. That happens a lot too.
Yeah.
And we're sort of at this convergence of data. So concluding thoughts with Chris Vermeulen. Folks, if you're on Twitter, be sure to share the room. Follow Chris at The Tech Traders on Twitter. Also, The Technical Traders at YouTube channel.
Yep. So many people think technical analysis is mumbo jumbo, is voodoo, all that stuff. And it is if you're trying to pick tops and bottoms. And that's what people always like to try to be seen for. And they try to call these out because then they look like a hero. But that's not the reality of money management. It's not about trying to pick tops and bottoms. It's about being consistent and just hitting first, second base hits over and over again and not taking a big loss. And so there's a huge difference between traders and technical traders who are trying to pick tops and bottoms and they want to be aggressive versus somebody who wants to protect their wealth, protect their lifestyle. It's all about, as you were saying, it's not about trying to beat the SP 500. If you can nail out 7% every year without any losses or small drawdowns, you're going to do exceptionally well through compounding versus some volatile account that makes 35%, loses 25%, makes 5%. Just people get hooked on they think if there's big, fast moving stuff, they want to take part of it. But chasing stuff is not how you make a living, really. So.
Yeah, exactly. Thank you, Chris Vermeulen. Check him out at thetechnicaltraders.com. Really appreciate it, Christopher.
Thanks, Josh. Appreciate it.